Today on the Joseph Carlson Show, we have a jam-packed episode. First of all, ASML reported their earnings. I hold ASML in my technology category. They play a crucial role in the chip-making process. Well, this company's going further into the red. Now I'm down $4,000 on this position. ASML is down to $650 per share, down 4% on the day after reporting earnings. ASML was hit with two different factors at the same time. First of all, there's a lot of unknowns with their guidance and their earnings, and of course there's the ongoing developments and escalation of the full-blown trade war with China. The United States and China are going toe-to-toe in this trade war, the stakes are getting higher, and the actions they're taking are getting incrementally more dramatic. The latest move in this battle is the Trump administration announced that NVIDIA is now completely blocked from selling their H20 chips to China. These were, up until now, the highest end chips that were legal to sell to China. This has a multi-billion-dollar effect on NVIDIA. The entire industry, companies like AMD, are also trading down based on this news. This tariff battle has major implications on every one of these companies. Now, while all that's going on, we also have news that Hertz stock. We don't talk about this one that often because it's not often that a well-known super investor buys a stake in the company. But we have Bill Ackman building his stake in Hertz. We'll be going over why Bill Ackman is buying this company. We also have some very unique news that Netflix had internal guidance leaked to the public of what the executives expect over the next 5 years, and they're guiding the company towards a $1 trillion market cap in 5 years. They also gave a bunch of different internal performance metrics that they're looking to hit. We'll be going over what this means for the company and their upcoming earnings. Now, we start today off with the breaking news, which is last night, NVIDIA informed investors that they were going to be required to have a special license to sell chips to China, specifically the H20 chips, and that their ability to sell them has basically gone to zero. The Trump administration is using NVIDIA as the latest bargaining chip in this escalating trade war. If we rewind time just a little, we can see how we got to the point of restricting NVIDIA's sales to China. It goes back to the tariffs overall. When Trump started the tariffs, they were broad and treated nearly every country the same, but he quickly instituted a 90-day pause for every country but China. China was the only country to take immediate retaliatory measures to the initial tariffs. Every other country is now given a 90-day period to negotiate with the Trump administration and make a trade deal. And many countries are reportedly in talks of doing that. Right now, reports suggest they're working with 130 countries and carving the trade deal. But China stands alone and now having the major focus of the Trump administration in this trade war. The tariffs have been escalated above 100%, and there's other measures being taken in the background. For example, Trump has made it a major focus on reclaiming the Panama Canal. After putting major pressure on the ownership of this port, one of the businesses decided to sell, in major part to BlackRock. BlackRock, of course, is an American-owned business. Trump hailed this as a reclaiming of the Panama Canal, saying that it's now under U.S. ownership. There are reports that as soon as President Xi saw this news, he was furious. Now, China has a whole tool set of retaliatory measures that they can dip into anytime they want. They started off by restricting access for more Hollywood films to do business in China, hoping that this would target American influence and target some of the most influential people in the world, Hollywood. Trump scoffed at that, saying that he's heard of worse things.
I think I've heard of worse things.
He didn't seem too concerned at the news that China was blocking more Hollywood films, but China's taken it a step further. More recently, they blocked all of their orders of Boeing planes. Now, China is a big buyer of Boeing planes. They're expected to have around 27 planes delivered this year, so they are a huge customer of Boeing. This is a much bigger escalation than blocking some Hollywood films. Each country is now digging deeper into their tool bag of leverage they have over the other country, and the next step for the Trump admin was NVIDIA. This is one of the biggest bargaining chips that the United States has. The highest end monopolistic chip maker in the world during a time period where everyone wants AI. The share price of NVIDIA fell around 6% after they told investors that the US government was now requiring a license to sell its H20 AI chips. The company said this will lead it to take a current quarter $5.5 billion charge related to inventory and purchase commitments for the chip. The inventory charge indicates around $13 billion in actual H20 sales, because when they buy $5.5 billion of chips, they can sell around $13 billion worth. So NVIDIA is basically saying that they're going to lose a lot of money in the process of having this large market share being closed off. Now, this does raise a related question, especially to NVIDIA investors, which is we've been told repeatedly that the demand for artificial intelligence chips far exceeds supply. There's so much demand, they can't possibly fulfill that demand. And here we have them basically saying that if China doesn't buy these chips, we're going to take a loss on them. Why are they taking a big loss on these chips? It's true that they're not the highest end chips, so maybe the biggest companies with the most money don't want these specific chips, but they can't find any buyers for these AI chips. There's no one else that will line up to buy them. That seems to run a bit contrary to the current narrative. NVIDIA should be able to fulfill this demand with someone else. Even though they're closed off from China, with the insatiable demand for AI chips, you would think that they'd be able to find a different buyer. Now this visual shows NVIDIA's sales by geographic breakdown. The gold part is China and the blue part is everyone else. So even though this is not a dramatic part of NVIDIA's sales, it's just a smaller segment, it is going to take a hit. NVIDIA is priced with high expectations of constantly beating their estimates. When you take out even a small segment of their sales, the opportunity becomes a little bit more limited. Another issue here is that NVIDIA designed the H20 chip specifically to comply with existing US export controls that limit the sales of advanced AI processors to China. So NVIDIA went out of their way to make this special chip just in compliance of China, and the Trump admin saying, nope, no more selling this as well. This effectively is bringing the business to China to a near zero. Dan Ives is correctly suggesting that Wall Street is pricing in that China is now basically a zero to NVIDIA, where it used to be 10% of their revenue. That 10% went away in a flash.
Street's basically going to assume that China is almost a zero for NVIDIA. I mean, this is really a blockade that started. And look, we know, what's the biggest asset we have? There's one chip in the world that's fueling the AI revolution. It's NVIDIA. So by them doing this, this is kind of the first shot across the bow in terms of what we're going to see. And obviously, there's going to be a huge ripple effect. But Street basically is going to, at this point, take numbers down by 10%.
Now, he's incorrect in saying that this is the first shot across the bow. We've seen the tit for tat up until now with the Panama Canal, with Hollywood, with Boeing, and now with NVIDIA. But he is correct in saying that investors are going to lower their estimates for NVIDIA around 10%. And that's a big hit for a company that's priced with exceedingly high expectations. And you can see the impact these tariffs are having overall across the entire industry. It's not just NVIDIA. This has a waterfall effect. If you go to AMD, this company's down around 7%. ASML is down 5%. TSM is down 3.5%. Applied Materials is down 4%. So it's not just ASML with their earnings trading down today, it's the entire industry. Investors are concerned about the entire life cycle of chip making, everything involved in it when we're talking about this trade war. Blocking NVIDIA chips is one of the biggest pieces of leverage that the Trump admin has. It's kind of like if they're playing chess, you're finally bringing out the queen when you're starting to play with NVIDIA. The inability to sell even the low-performance chips into the Chinese markets shows that this trade war will scramble its businesses. NVIDIA is now caught between the world's two superpowers as they jockey to take the lead in AI development. NVIDIA is trying everything they can to be able to open up as many markets as they can. In fact, the CEO of NVIDIA, Jensen, attended a dinner with Trump at Mar-a-Lago earlier this month. This created a lot of speculation in the media, people saying, he's going to sweet talk Trump, he's going to say how great he is, and then Trump will back off of its plan to ban H20 sales in China. So this gave a little bit of a false hope that meeting with Trump would shield his business. And this strategy of meeting with Trump or donating to his campaign doesn't seem to be working. Another example of these lobbying attempts not working is Mark Zuckerberg. Mark Zuckerberg has failed to negotiate an end to the antitrust case, no matter how much he tries to be on Trump's side. Meta is under a huge lawsuit with fines of up to $30 billion by enhancing their so-called monopoly by buying Instagram. Mark Zuckerberg called the head of the Federal Trade Commission in late March with an offer. He would pay $450 million to settle the long-running antitrust case. Now, $450 million is a far cry from $30 billion. On the call, Zuckerberg sounded confident that President Trump would back him up with the FTC. The billionaire Facebook co-founder had been developing closer ties with Trump. His company donated $1 million to the Trump inauguration and settled a $25 million lawsuit. Zuck also traveled twice to Mar-a-Lago after the election, including for a dinner with Trump, and attended the inauguration in January. And despite all this effort of Zuckerberg, who has spent tens of millions of dollars in recent years aiming to rebuild relationships with Trump, The failure to reach a deal or a settlement with the FTC shows that he isn't getting much of a return on this investment. Some people around Trump have warned the president that Zuckerberg's MAGA rebrand is disingenuous. And despite Nvidia also looking close with President Trump visiting Mar-a-Lago earlier this month, it doesn't seem to have much of an impact. Trump is both allowing the FTC to go after Meta full steam ahead, as well as blocking these chips from Nvidia. And this escalating trade war continues to impact investors and their portfolios, as well as, of course, many businesses. There are a couple ways that I see this playing out. One of them is not good. It's the route of further and further escalation to extreme levels of escalation, leading down to one concern that Warren Buffett has held for years. Remember, there was a short time period where Warren Buffett owned TSM. He bought into the stock. A lot of investors were very excited about it because TSM is a great company. And then only a few months later, Warren Buffett sold completely out of the holding. And in fact, the holding was trading right around where he bought it. When asked to clarify why he ended up selling out of TSM, he highlighted his only concern.
Taiwan Semiconductor is one of the best managed companies and important companies in the world. And I think you'll be able to say the same thing 5 or 10 or 20 years from now. I don't like its location, and I've reevaluated that.
He calls TSM one of the best companies in the world and believes it will be that way for the next 10 years, and says he doesn't like the location. Why wouldn't he like investing in a company that's located primarily in Taiwan? Obviously, without saying so, it's the close proximity to China.
Marvelous company, but I'd rather find a marvelous people. I won't find it in the chip industry, but marvelous people and marvelous competitive position and everything. I'd rather find it in the United States.
The one and only reason that Warren Buffett and Berkshire Hathaway don't own TSM today is precisely because of the location, and without saying so, it's because of the proximity to China. Taiwan is strategically one of the most important countries in the world for its large market share of high-end chip making, and it's in close proximity to China. The United States knows that if Taiwan was to be taken over by China, if they were able to control the inflows and outflows of that technology, that would be disastrous to not only the United States, but also the rest of the world. And while it looks like that possibility is extremely slim, there's always the possibility of it. And Warren Buffett has weighed that possibility into his investment case. Warren Buffett does not like buying any company with even a 1% chance of having a disastrous outcome. Being primarily located in Taiwan, and Taiwan being so close to China, that creates investment risk that Warren Buffett doesn't want. With this tit-for-tat escalating trade battle between the US and China, it does raise the chances of China acting more aggressively towards Taiwan. Now, even so, I have some exposure to TSM as well through ASML. ASML has many of the same risks that TSM does, a concentration of production and devices in Taiwan. And even though I agree with Buffett, I'd much rather have the majority of production within the United States, I also still believe there's a very small chance that China acts aggressively towards Taiwan. But if China decides right now to act aggressively towards Taiwan, it'll further insulate them from the rest of the world. China would quickly be viewed as an aggressor, a country that cannot be trusted under any means, right during a time period where China is working very hard to make themselves look like a measured place of business. If China acted aggressively towards Taiwan, it would work contrary to many of the goals they're trying to establish over the past 10 years. It would force every other country to turn their attention against China. It would realign other countries further with the United States. So there is a small chance that this trade war escalates out of control. And that chance would harm companies like TSM, like Applied Materials, like ASML. It'd also have major disruptions in other companies as a waterfall effect. But I believe that scenario right now is very unlikely. There are companies like Amazon that are trading below $180 primarily because of this tariff war, but these concerns should be temporary in nature. Both countries know that a 100% plus tariff is not sustainable in the long term. I believe the best course of action is to continue to invest, especially in companies that can make it through difficult times, companies that have high margins that they can work with. They can take a punch. Companies that grow bigger after periods of struggle. And these type of companies comprise the majority of my portfolio. They're typically digital companies selling high margin goods with incredibly wide moats. They're companies with high barriers to entry. And in the majority of cases, they don't sell products that are tariffed to begin with. During a time of uncertainty, it's especially important for investors to stay the course. Now, moving on from the trade war talk, we get into more specifically ASML's earnings. The numbers are as follows. Net sales were $7.74 billion against $7.8 billion. So they missed their revenue or their net sales by $0.4 billion. That's a miss by a couple percentage points. Their net profit was $2.36 billion versus $2.3 billion. So they actually beat on their net profit. Overall, this is not really what I consider a miss. This is right in line, business as usual. One of the metrics that was meaningfully hit negative was the net bookings. This is a key indicator for the order demand. It came in at $3.94 billion versus $4.89 billion expected. So the shares are down in part because their net booking didn't encourage investors a lot. It shows uncertainty. ASML didn't really blame tariffs. They just said that overall it's becoming a little bit more difficult to predict. The CEO of the company said that the demand outlook remains strong, with artificial intelligence staying as a key driver. And like you would expect, he added that there's a greater level of uncertainty with some of our customers. I've warned that that's something that's going to be repeated over and over this quarter. Overall, this was a fine quarter from ASML, which now trades at a very low valuation. I'm still very bullish on this company. I like the positioning of it, and I think that ultimately, looking 5 years out, I'll have made money on this one. Now, moving on, we get to some shocking news here. Hertz Global, the rental car company, is up 21% today after it was revealed in the 13F that Bill Ackman bought 12.7 million shares of the company. Now, to put that in perspective, one share of this company is not that much. It's $4. So even though he bought 12.7 million shares, that's still, as of now, a really small part of his overall portfolio, 0.37%. Now, I have to be honest here. When I first saw the news that Bill Ackman bought shares in Hertz, I thought, what is he doing here? This is a bit crazy. Bill Ackman says that he likes to buy free cash flow generative companies, ones with solid moats, incredible leadership, businesses that are already have momentum and continue their momentum. He likes to buy those type of companies. And then his next purchase is a car rental company. Now, I could read through the description of Hertz Global, but that's all you need to know. It's a car rental company. If we take a look at the financials, just a quick tour of the financials, it gives an idea of what this company has done. The revenue has been flat for 10 years. The EBITDA, this profitability proxy, is all over the place. It doesn't paint any type of progress of any kind. The free cash flow is negative since the beginning of this company. But I will note, if we look at the past, it shows a good picture of the free cash flow becoming less and less negative every quarter. I like this trend towards positive free cash flow. The net income and earnings per share are also deeply in the red. The company has no money to pay a dividend, and it's not returned capital through buybacks either, because again, it has no money to do this. The company's balance sheet is also incredibly indebted. If you look at the amount of debt just last quarter, it was $16 billion. Now, they do have a lot of cash to work with. They have over $1 billion in cash, so they're not in imminent danger right now, but this is a fairly leveraged company. When I look at this purchase from Bill Ackman, it is clearly a turnaround play. A company that is somewhat distressed and has right now temporarily horrible financials. The company, after all, just went through a bankruptcy in 2020, reorganizing the way that it's running, the way that it can run efficiently, and that's something that Bill Ackman has helped out with in the past. After all, Bill Ackman did buy Chipotle during a time period where the stock was distressed. Same-store sales were falling. They had gone through multiple problems with food poisoning outbreaks, and they had to reorganize and restructure the entire company to have much higher levels of food safety protocols. I see the situation somewhat similar, that this is a turnaround play. It's an opportunity to buy into a company that's heavily distressed, reorganizing, and could have much greater upside. But overall, I still believe that Hertz, even at its best, is a low-quality company. So this is one that, even though Bill Ackman is buying into it, and it may make for a great temporary turnaround play, it's one that I'll be avoiding. Now, moving on, we get to some news that I found a bit shocking. In fact, as long as I've followed this company, which I've followed it for years, I've never seen this happen before. Netflix executives had long-term financial guidance of the company and financial performance targets be leaked, and we got an insight into what their specific financial performance targets are. Now, one of them, and this is one of many, is they actually named off a market cap goal. Netflix aims to achieve a $1 trillion market capitalization and doubling its revenue by 2030. Right now, Netflix is around a $400 billion market cap. So if they got to a $1 trillion market cap by 2030, that would be an increase of around 150%. A 150% return over 5 years will almost certainly outperform the S&P 500. So if they hit this very aggressive goal of becoming a $1 trillion company, from today, they will far outperform the S&P 500. And that does not include buybacks, which is a huge part of the total return of this company. Like they said here, they want to double the revenue by 2030. So a doubling of the revenue would be a $78 billion and a 15% revenue CAGR over the next 5 years. Not only do they want to double the revenue, they want to get the ad tier up to $9 billion in global sales by 2030. Right now, that's currently around $2 billion, so they're expecting explosive growth in the ad tier. They also have operating and profit metrics here, saying the executives also have a goal of tripling Netflix's operating income by 2030 from $10 billion last year to $30 billion. Another metric that they're guiding to by 2030 is to have around 410 million subscribers. Right now, they have around 301 million. So that's a gain of around 21 million per year. These are some wildly ambitious targets. Doubling revenue, tripling profits, gaining 100 million subscribers. That is some incredibly ambitious metrics. But of course, this is all just goals. And goals are exactly what they are. They're hopes of the future. When we look at what Netflix is doing here, they leaked this information, we don't know whether intentionally or not, 2 days before earnings. Now, why would Netflix come out and say all this bullish stuff 2 days before earnings? There's a couple different arguments here. One of them is that they're doing this because they're expecting to have really poor earnings. Earnings are going to underwhelm, so they're trying to kind of front run that with a really positive long-term perspective. This is a way of shielding investors and kind of prepping them for the bad quarter. So some investors are taking this to mean that this quarter is going to be rough. They're going to give bad guidance. They're going to have a slowdown in revenue. It's going to be bad overall, and the stock will be down 10%. Now, the other group of investors are looking at this and getting the exact opposite take, that Netflix wouldn't come out and say all these grandiose plans over the next 5 years if they knew that this quarter would be bad. They would instead try to temper investors' expectations. They'd talk about being cautious in the near term. Overall, this news is just a rehash and a restatement of what I've been saying about Netflix for the past 5 years. I firmly agree with everything the management is saying here. This is Netflix's game to lose. I don't see any meaningful deterrence or competition to them. I don't see any meaningful obstruction of their goals. I see a company with an incredible opportunity. There will be volatility over the upcoming earnings report, but Netflix in my mind remains today one of the most predictable and best investments long term. That's going to be it for this episode. See you next time.